This John Lothian News video is sponsored by What did you learn working with Edward O. Thorp?
One of the big lessons was to really question your edge and to not just look at simulation results and even live results and calculate a Sharpe ratio or some other goodness metric and assume that really means anything, because it very likely may not mean anything. That was one big lesson. I also learned to keep things simple when I could. So many times in the industry, in the CTA industry, I see a lot of parameters and curve fitting with other managers with their trading systems. They're complicating things too much, and they're sort of flooding their own trading systems with overfitting.
What are your thoughts on trend following?
Markets move further and at times faster than an efficient market would do. And it appears that herding behavior, including investors reacting to fear and greed and other human emotions, tend to produce globally diversified trends at times. And as trend followers, we develop trading systems to efficiently capture the alpha embedded in those trends. It does make intuitive sense that trend followers do well in increasing volatility periods and even in constant volatility periods where it's not really rising or falling, but the falling volatility environments have wreaked havoc.
Tell us about the Sortino Ratio and Sharpe Ratio.
The only correct way to look at returns in the futures markets is a risk-adjusted return. The most popular is the Sharpe Ratio, but the Sharpe Ratio assumes that the returns are normally distributed, and essentially what that means is it rewards and penalizes downside volatility the same as it does upside volatility. The Sortino Ratio comes along and basically corrects that portion of the Sharpe Ratio. And so managers that have produced good risk-adjusted returns, but with fat right tails, some surprises on the upside actually score higher in the Sortino Ratio.
What are your thoughts on developing new investment styles?
We have studied the commodity future, specifically the physical commodity future space, in great depth the last several months, and there appear to be some inefficiencies that we can exploit using a unique pattern recognition technology. And we look at price return, volatility, the term structure of the markets, volume, and liquidity, and also location of the market. And our strategy has an average holding period of only about 8 to 9 days.
What's the potential for the managed futures space?
It's just taken institutions a while to wrap their heads around whether or not managed futures is an asset class. And I won't argue either way on that, but I know for myself, I prefer to have a healthy amount of exposure to managed futures, not only for the 2008 sort of years that may happen again, but also in general, different alpha drivers are driving the markets. And with one investment, with a trend follower, for instance, you're getting quite a lot of global diversification if you choose, one that trades those sort of markets. So I think if the managed futures industry can get by this tough period that we're in right now, I think it'll be onward and upward.